Our next guest warns the rotation into economically sensitive stocks is hitting extreme levels. Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, great to see you.
Great to see you, Mel.
I'm going to pose that same question to you, and I know you can't talk specific stocks, but let's say a mega cap tech stock like an Apple, which is seen as sort of a higher quality, more defensive name, versus, a more cyclically oriented name the next 1 to 2 years. Which would you rather?
Cyclicals. But again, I think that, Mel, that rotation, as you know, from last summer when it was really unpopular, we were with what we call banks and tanks and the economic reopening trade, because you had this extraordinary excess liquidity and such a friendly Fed that was going to fuel a synchronized global recovery. But that, to put it to you this way, the Russell 1000 growth versus the Russell 1000 value relative trade has given back all the gains since last March. How about that? So that's how extreme the move has been. On an absolute basis, the Russell 1000 growth is back to where it was in August of last year. So all those gains, everybody's like, you got to get in, you got to rush in. They've given them all back. That, I think, creates at least a near-term potential for a bounce in some of these mega cap tech names and these stay-at-home growth names that have been hit so hard.
Tony, this is Bono, and thanks so much for making yourself available this evening. A quick question for you. On this rotation, can you see a situation where we have a rotation or a continued rotation out of growth into value and the market trades sideways? Can you kind of help me understand or quantify to an extent what you think the market return result is from this rotation?
It's a fantastic question, Bono, and because it's when you add up information technology as a S&P sector and add in Facebook, Netflix, Google, and Amazon, which used to be in the infotech sector until 2018, it adds up to about 38% of the market as of a couple of weeks ago when I measured it. So what that means is because you're taking a lot of you're taking a pretty big hit in those areas, it's subduing the S&P 500. And as Mike Santoli's been reporting all day, the equal weighted S&P was actually up today. So we've been calling this a rotation sensation, where you've just had to move out of those mega cap stocks. And now it's very popular to go into the cyclicals, which again, I think it's been extreme enough. Although I want to be there for years. This is one of those, we have a global recovery with backlog and supply chain issues that's going to carry growth forward for years. However, there's going to be periods of correction where some of these cyclicals, I think, Bono, want to take a hit relative to growth. And I think we're entering that point, especially because rates have probably seen a pretty stable level up here.
That's what I was going to ask you, Tony. David Tepper made comments today about exactly that, thinking that maybe yields would stall around this 1.6%. But let's say, they continue to move to the upside. I thought 1.5% in the 10-year was sort of that line of demarcation. Where do you get concerned overall market-wise if rates get to? For a lot of people saying 2%. What's your sort of line in the sand?
Boy, do I miss seeing you guys on set. Guy, I don't think it's a level. I think that's a big mistake we make. What's the level? You don't know the exact point. What you know is when it number one worsens financial conditions. So even though rates have gone up to 1.6%, the national financial conditions sub-indices that measure 105 credit stress indicators out of the Chicago Fed have been improving, easing financial conditions despite the rise in rates. And inflation break-evens over the course of the last month have been basically flat, meaning market-based inflation expectations, even though you've had a 30 basis point rise in the 10-year. So what I'm trying to say simply is you don't look for a level of rates, you look for a time when financial conditions stop easing. I think that's happened in the last week. And when inflation break-even stop going up, and I think that's happened in the last month. So I think we're right around there. We're in this choppy area where the tactical side is in no man's land, and yields are probably near their extreme, as Mr. Tepper said.
Tony, great to see. I know you said you missed us. I think you missed the candy bag.
I totally missed the candy bag.
We'll see you soon. The candy bag lives, by the way. It lives. Tony,
awesome.
Good to see you.
Awesome.
Tony Dwyer, Canaccord Genuity. Tony speaks a lot of reason, Karen, very rationally about how the market should interpret rates, and yet here we are. Market throws a tantrum whenever rates go above a certain level.
Right. On a day-to-day, it feels like a tantrum, right? But if you step back, I mean, it doesn't move exactly linearly. I think what he's saying makes great sense. It's an interesting point that even though rates are moving, that inflation break-even has not moved. So I think we will see that inflation maybe be transitory. So all that having been said, though, I'm staying long banks. I agree with Tim. They will trade off if rates come back down, but that's okay.
Shepard Smith here. Thanks for watching CNBC on YouTube.